Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. India's foreign exchange reserves have hit a record $322 billion. This is the first time after September 2011 where it saw a high of $320 billion. Now, this gives the country 9 months of export cover compared to 6 months in 2013. This is a very significant event, but what does this mean more importantly for the country from a strategic currency point of view, as well as for exporters, as well as the larger deficit question? Well, joining me now to discuss the implication of these high forex reserve numbers and where it could go, which is more important, I am joined by Sujan, Hajra, Chief Economist at Anand Rathi Securities, as well as K. Day, Senior Advisor to Mecklai and Company. Sujan, let me begin with you. How does a figure of 322 billion, of course we are in the top 10, but we are number 9 as I can see in the global ranking. What does that mean to you?
See, obviously, if you just go back to say between 2006 to 2008, India was again in the top 4 in terms of forex holding. Obviously, after that, we have depleted quite a bit of forex reserve thanks to the global crisis. So, obviously, this generally means this gives you greater resilience to withstand external disturbances. And given that right now the global economy is slowing and there are certain amount of uncertainty, particularly in the euro area, so this gives us
the cushion that we perhaps are looking for a while, considering the last record was in September 2011. Mr. Day, to you, how do you interpret this, coming more from a forex background?
Hi, I personally feel 322 is not a very big reserves, though in our term it will be the highest. But I would be love to see the reserves still further ahead of 400, because last time when this 322 number was there, our external debt was around 280 billion dollars. Our reserves were around 130% of the debt, and today at 322 billion dollars, our external debt is around 440 billion dollars. We are just 68–70% of the external debt. So obviously the reserve should be somewhere way above the external debt, could be around 450–500 billion dollars. So this is, to me, and today's market is pretty low.
Does that also mean that therefore the Reserve Bank, as they've already said, should focus on building the reserves further?
Absolutely, they have to go ahead. There is no other choice. We need to build up the reserve, because if you just go back about a year and a half from now, when Dr. Rajan took over the reins, he had done I think Tier 1 and FCNR about $41–42 billion, which I believe needs to be repaid back in November 2016. So $41 billion will definitely go out from these reserves. And going ahead, if we don't shore up the reserves, say somewhere over $450 billion, I think we are still far below.
Sujan, the reserves are there. I mean, we need to build it, as Mr. Day was saying. What does it mean for someone whose business, or in a way the enterprise, depends on a rupee? Should they be thinking about, approaching or hedging or so on?
See, the basic thing what you have to understand is that RBI's philosophy of forex management is not to target a particular rate or a particular level,
right,
but to basically reduce the volatility, particularly sharp volatility. So, given if there is greater level of reserve, that obviously gives RBI more elbow room to manage this volatility, so that the changes, whatever is the trend change, will happen, but it will happen over a longer period of time rather than one shot changes. So, this suddenly the hedging, from the perspective, the issue of hedging remains important, even if it's
even whether the rupee was. So let me ask the rupee question to Mr. Day. So there have of course been voices from the government which have hinted at allowing the rupee to become stronger, or working towards a stronger rupee. What's your sense? I mean, does this milestone in some ways trigger or should it trigger any action?
Well, there are too many people telling too many things about the currency market. I honestly feel Reserve Bank of India has an excellent job in keeping the rupee in a band, to some extent moving of 1–1.5 rupee. If you see today the dollar index, which is at 94 plus, and when the dollar index last about 2–3 months back was at 82, the spot was around 61.70–80, which is as of today. So indirectly the rupee has been really being overvalued as of today. But thanks to the capital flows coming in on account of FIIs and ECBs, the flows, the RBI is able to bear to maintain a reserve. So honestly, a stronger rupee as of now, it may not be so good, but to me, a stable rupee, maybe in a band of 61, 62 or 62, 63 is very good for the economy, because that will make the exporters and the importers really not worry about which way the rupee is going, but as long as it is in a band which they can easily manage it.
So the reason we are also seeing reserves is because there are flows, and there are very strong flows, and they're likely to continue both in debt and equity markets. What does this mean for a larger, balancing the budget or the books of the government point of view, Sujan?
First and foremost, let me tell you one very basic thing, that unlike China, we have a current account deficit.
Yes.
So reserve we build.
But that could become a surplus as it looks.
It might not. It might not.
Okay.
Given that your exports are significantly lower than imports, and even if the oil imports come down, having a trade surplus, I think we had a freak trade surplus in the mid-70s. Apart from that, we have never had a trade surplus. So that's more unlikely. So the point I'm trying to tell you is that in India, you can build reserve only through capital account surplus. And in terms of capital account surplus, as Mr. Dev was pointing out, your external debt has crossed 400 billion, closer to 450 billion. And also a significant part of the build-up is happening because you are seeing huge amount of portfolio flows. Now, what you have to understand, a significant part of the portfolio flows, almost all of it, can actually potentially evaporate very quickly. Second thing is that even if you look at the external debt, the component of trade credit and that is pretty volatile. If you look at the external debt, the component of trade credit and that is pretty volatile in the sense that it's by definition less than 360 day. So in that sense, even if you are having a huge amount of reserve, the liquidity at risk is pretty large.
Okay.
So there is a need to build up, but at the same time, when you are building reserve, what does it mean? That RBI is buying foreign exchange and in turn injecting rupee liquidity.
And that's really the question, whether it should be doing it, or at least as some people would ask.
Yeah, so basically what you do when you inject rupee liquidity, you also absorb a part of the rupee liquidity but through your open market operation. So therefore, you don't allow the capital to get absorbed in the economy.
Okay.
So too much of sterilization also will stop the external funding route. So while building up of reserve is a welcome thing, it's not an undisguised benefit kind of thing. There are certain costs also associated with that.
Okay, Mr. Dev, the costs of building reserves, how do you see them?
Well, I think that's a cost which I think RBI will have to take into mind. There is no way, because in 2013 RBI brought in some dollars in the FCNR by paying a cost of 3.5%. So that's a cost which we have to bear it. I think RBI can bear it for building up a reserve, because there is no way out. One thing also I just want to remind you is that going forward somewhere in the second half of 2015, we would see an Indian rate cut coming in force and also an US rate cut going up. And once you see the yields of India not very lucrative as compared to the US yields, 10-year yield, there would be a capital outflow from India from the debt market, which one has to be ready for that. And if you go back to history of just 2 years back, 2013, the fall of the rupee from 53 to 58 was most a part of that because of the yields in US were higher than yields in India. And I think in a gap of 30 or 40 days, $7 to $8 billion moved out from the debt market, from Indian market to the US market. So fearing that might happen in the second half of this year, I think reserve building, and if there is a cost also attached to that, that should be built into.
So very broadly, Mr. Dev, and I'll come to you, Sujan, in a second. If we were to sort of frame a strategy here on, right, as India, given where our debt position is, given our desire for a certain amount of stability in forex markets, what should be the strategy?
Well, try to shore up as much as dollar possible. Try to keep the rupee in a balanced, maybe in a band, whichever band RBI wants to fix it. Maybe a band of maybe 61.50 to 62.50 as demand picks up, the band could move upward, but not to allow the rupee to go too strong. As you said in the beginning, that RBI will try its best to control volatility. At the same time, try to build up the reserves closely to $450 billion to face any future problems if it does arises.
And are you anticipating any future problems? I mean, in the sense from the signals that you are seeing around you?
Yes, I do see some outflow coming in once we start cutting our rates full and US starts hiking somewhere. I said you in the earlier about maybe May, June, July, where yields in US becomes more attractive than yields in India. There could be certain outflow from the debt market, which I am sure of RBI must be keeping in track.
Right. Strategy from here on, Sujan?
I think, see, there are various ways in which...
Are there any lessons from the past that we should be looking at?
No, that's what, in the past, say, somewhere around 2007, we were telling that RBI is holding too much of reserve. How much reserve is sufficient, that was a debate, and the emerging markets, they are storing up reserve, and that was taken as a reason for global imbalance. So again, if you look at China, China is holding about, obviously in $1 trillion, $3.5 trillion kind of reserves. I think India needs reserve because you have a huge trade deficit and a significant current account deficit. You have huge amount of liquidity at risk. And as Mr. De was telling, I think I look at reserve more as a gives RBI elbow room to continue with a softer monetary policy, because ultimately rate cut potentially should result in depreciation of your currency. But at the same time,
can you explain for our viewers how?
See, what is happening is that when you are cutting rate, so your there is an interest differential.
Yeah.
So for that interest differential to equate, your currency should depreciate.
Okay.
Now that's called the covered interest parity. Whether it holds or not, that's an empirical question. But theoretically, if your currency, if you are using your monetary policy, that should result in depreciation, and on the top of that, US is tightening.
Right.
So the differential increases both ways.
Right.
So in that sense, rupee should depreciate because of that. Now, also there can be uncertainty coming from Greece. There can be uncertainty coming from slowdown in China. All these things taken together, and there is always these are known unknowns. There are always unknown unknowns, which can create further problem.
Right.
So given that. I think this gives actually RBI more elbow room, and we should see RBI building the reserve so that now the foreign exchange policy rather than inflation is a greater determinant of your monetary policy going forward, and RBI is creating that room through stronger accumulation of reserve.
And we should, among other things, also then watch out for when the next interest rate comes to see if the alignment takes place as you were talking about.
Sure.
Sujan, thank you very much for joining us. K. Day, thank you very much for speaking with us. We take a break, but coming back on the other side, we talk about the new foreign trade policy that's around the corner. Stay with us.
Hello and a very warm welcome to a brand new edition of World Panorama with me, Frank Pereira.
Barack Obama has been elected on the basis that I will no longer take America into wars, and in fact quite the opposite, I will pull America out of wars.
According to the Indian government, fishermen are not at fault.
The US intervention in Iraq set the stage for exacerbation of these conflicts, and then the intervention in Syria.
Watch World Panorama at these times on Rajya Sabha television.
तकरीबन एक साल में दूसरी बार होने जा रहे दिल्ली चुनाव में पूरे देश की निगाहें हैं।
इतना सघन राजनीतिक सक्रियता का दौर देश के किसी हिस्से में नहीं था।
जिस चुनाव में एक तो सबसे बड़ी कठिनाई ये हुई कि ये पर्सनालिटी की लड़ाई आम आदमी पार्टी और बीजेपी ने शुरू कर दी और मुद्दे जो है साइड हो गए।
आपके पास जितना भी मुद्दे हैं, जब तक आओ मुद्दे को रिप्रेजेंट करने के लिए एक चेहरा नहीं होगा, आपके लिए वो लड़ाई मुश्किल हो जाता है।
जाती रही भावना जैसी, प्रभु मुहूर्त देखी दिन जैसी।
देखिए सरोकार सिर्फ राज्यसभा टेलीविजन पर।
Well, joining me now to understand the implications of this new foreign trade policy when it arrives and what are some of the issues, both procedural and otherwise at hand. I'm joined by Rahul Mehta, President of the Clothing Manufacturers Association of India. Rahul, thank you very much for joining us. So, you've been exporting for more than 3 decades, garments, and you're one of the larger ones in the country. So, tell us, where do things stand today? What's the environment or what's the landscape like for an exporter out of India?
Well, right now, I would imagine that
the slightly positive period has seems to have come back after a long period of about 3 or 4 years of virtually no growth or negative growth. This year, I think we will end up with about 17 to 18% growth in dollar terms. In rupee
that
terms,
sounds like
it
a substantial number.
Yes,
yeah.
it's good growth. Largely, I think because China seems to be moving out of the low priced, low cost, low value industries, garments being one of them. So there is a certain amount of growth that China would have got, which seems to have been coming towards India. Bangladesh, as you might have heard, is facing certain issues in terms of labor laws, safety, etc. And of course, this year, last 18 months, our dollar-rupee parity has become a little more favorable. So all these three factors combined with some of the efforts which the government and industry had taken over the last 4 or 5 years, which is to start diversifying our product basket, our market basket, all these things have sort of combined to make it into a slightly more favorable situation. So in spite of the world trade not really booming, I would say we've achieved a fairly healthy growth.
Right. So you're saying two key contributors to this have been the China factor and the Bangladesh factor. Bangladesh more in the case of garments, but China could be many more.
Yes.
But how competitive are we today? I mean, have we used the last so many years to become more competitive? Because we had become uncompetitive in some ways, isn't it?
You see, if you look at ourselves in isolation, I don't think we have become more competitive. I'm trying to make a fine distinction between becoming competitive because of a lower cost of production or higher productivity or lower cost of labor. In that sense, we have not become more competitive. We have become a little more competitive in relationship to the other two major sources of supply, China and Bangladesh. Both are becoming more expensive. China, the labor wages by law has to increase 17% every year. So that's helping us. Bangladesh, wages are becoming an issue. Labor is becoming dissatisfied, so they are increasing their prices. So in that sense, we are becoming a little more competitive.
Right. So if you were to look forward now at India's foreign trade policy, let's first look at the procedural issues, right? I mean, so some of the issues have been for smaller manufacturers, you know, sending small samples, the ability to not get charged duty, you know, and all the problems that small enterprises face. That's one. Are there others that you feel that?
Well, in terms of procedure, I think nothing unique for the garment industry, but some of our basic inherent weaknesses like lack of infrastructure, the shipping and port problems, the cost of finance. I think these are some of the issues which are becoming more critical for the garment industry, which is a low cost, low value industry. So let's say an additional 3% cost of finance may not mean too much in the software industry, for example. Becomes a very crucial factor in a labor intensive garment industry. So I think that these are some of the issues that I'm hoping that with the Prime Minister's initiative and emphasis on Make in India, these are some of the areas that the government will focus on.
Right. So the FTP is likely to coincide with the union budget, right? So what are you expecting or looking out for from a policy point of view or a procedural point of view?
Well, as I said, I think the focus will have to be on making the finance a little more competitive, where as of now we are paying substantially higher than many of our other competitors. I think that will need to be done. Number two, the policies should become more consistent and easier to implement. For example, you have the ECGC, the insurance. The policies are so complicated that a small medium manufacturer does not find it worthwhile going through all that hassle. TUF, for example, it's an excellent scheme.
But what does TUF do?
That's the technology upgradation fund.
For textiles.
So the scheme is excellent, But it has so much of paperwork, it has so much of preconditions that a small person, unless he is really wanting to invest 10 crores or 20 crores, really doesn't feel it is worthwhile. Which is why this scheme, which is for the entire textile industry, finds itself more preferred by the textile manufacturers rather than the garment manufacturers.
Right.
So these are some of the things that they will need to do. But I'll tell you, the most worrying thing which the government will have to think of is that under the WTO agreements, if a country crosses a certain percentage of the world trade share, it cannot any longer give incentives to that particular industry.
Right.
And we have either crossed it or on the threshold, or and by 2018, all the standard incentives will need to be stopped, like duty drawback and so on. So this is where the challenge really is for the government.
But the delay in this policy also seems to be because of the lack of harmonization or the inability to harmonize the tax incentives, isn't it?
Yes, that inability is there, and I think we still need to put on our thinking caps and figure out how to not infringe the agreements and the laws that commitments that we've made, and at the same time make sure that our industry remains competitive, at least to this extent.
So if this industry has to grow, I mean, I'm talking about exporting in general, and we could use clothing or garments as a case in point, and scale up substantially, particularly from a trade point of view. Are we suitably geared as things stand today?
Well, I would say yes and no. Yes, we are geared in the sense that the intent is there, the capability is there. The question is that the execution seems to be lacking as of now, and which I would put the responsibility both on the government as well as the industry. I think we need to substantially increase the scale of our production. We need to pay far more attention on the productivity, which seems to be rather low at this point of time. We need to continue expanding our product base. Today, we are far too focused on the summer casual clothing, and we have virtually no share in the world trade of the winter clothing, the specialty clothing, utility clothing. We have no share in that. We need to increase our base there. For that, we will probably, the government will need to make imports of those fabrics more easy, perhaps cheaper, till such time that our textile industry gears up to manufacture larger quantities of these kind of specialty fabrics. So we need to do these. The government needs to make sure that or to accept the fact that we are still the second largest employer of labor after agriculture, and therefore not think in terms of what advantage the entrepreneur will get or the businessman will get, but really focus on how to increase employment. And if that becomes the focus, I think all impediments to the growth of garment industry has to be overcome. And government, if it focuses on it, can do it. I mean, they were the ones who gave something which was unthinkable prior to that law, which is making exports income tax free. So you can take that kind of a step again.
Right. Okay. So if I mean, I think we've talked about a couple of things. I mean, some are sort of direct policy interventions, some are indirect policy interventions, but and some are directionally good things to do, like the whole Make in India initiative, which should eventually help. What's your sense? I mean, if assuming some of these things were to fall into place, and you're already looking at a global advantage today because China and Bangladesh are now declining, facing or displaying declining production. Are we in a position to grab that space, and if so, how and when?
We are in a position to grab that space. We've got some unique advantages. A, we've got the entire value chain with us. B, we have got the skill that is required in the hand skill that is required in stitching and tailoring and so on. We've got the skill in terms of value additions, in terms of embroidery and sequins and that kind of thing. So I think what we are sitting on the cusp. We've got all the potential to do it, but as of now, unfortunately, the industry is not very profitable. And that is where we say that if we can make ourselves, by policy initiatives, the industry a little more competitive, therefore business will go up and therefore profitability will go up, which will make more people invest into the industry. Today, investment has come down because of the lack of growth for the last 3-4 years. I have a feeling that with this, if the 17-20% growth continues for another year or 2 years,
you'll see more investment.
You will see more investment. That's going to help.
So, last question: how are you looking at the rupee? Is that something that you're comfortable with? Are you comfortable with the government or the Reserve Bank more specifically managing it the way it is, or are you concerned?
I think as of now we have reached a fairly stable parity, and 60-61 I think is about the kind of value that we would
no, and the reason I ask is, I mean, our reserves are going up, and obviously when reserves go up, there could be a clamor to say, okay, maybe we should allow it to float a little more.
Well,
upward.
You know, I mean, this is a catch-22 situation. The better your economy does, the stronger your currency becomes. The stronger your currency becomes, perhaps, the less competitive you become in the world economy. So, that's a balancing act which the RBI will have to play. They're doing a fairly good job till now. Hopefully, they will continue to do that.
And are you expecting 2015 overall to be a good year for?
I'm expecting it to be a good year for the exports.
Right, and let's hope that the new trade policy also gives you the wings that you need.
Keeping the fingers crossed.
Right, thank you very much, Rahul. Well, that's all we have time for on this edition of Policy Watch. We'll be back next week, same time. Thanks for watching.